All right. Good morning again. God bless it. I tell you, my system has a few checklists always, and if you forget one, I just can't get it. If you can't hear me, let me know, but hopefully audio should be good. Now, let me know if you can hear me. Um, Happy Friday again. You didn't hear me say it the last time with my audio issues, but starting a little bit late. Never can quite get the 11 o'clock start London. Thank you, Tamam. Good morning. Thank you. This is always running into something here. But I wanted to go through some money supply charts again and look at Bitcoin again because obviously Trump wants even lower interest rates. There's going to be a new Fed chair soon. And, you know, it's a lot of noise for people when you think about the money supply. And my goal, as always, I think, is just to look at this in a calmer way, big picture way. We'll see if we can find any, not necessarily, you know, hot tricks or anything, but just to get a better perspective of what's happening. So, without further ado, showed this last quarter. This is for the United States. And I really will make an effort here this summer to get the other major currencies on a global level with this because I think this is, you know, shows a lot of what's going on. So the money supply here in dark green, you got to use M3. US hasn't published M3 since 2006, so I have this reproduced M3 here. It's about $36 trillion. You can see big bumps here from the pandemic. You can see a big bump here before the GFC. Other than that, you can't see much. A little bit sort of crests and tops. Almost looks like the rate of growth is slowing here, mid-90s, which is interesting. But we can layer over the money supply with debt, and they're going to be pretty close. Okay, so here's the federal debt now. And we can do a ratio. Okay, so U.S. remains one of the poorest regulated economies, in fact, because even though they like to claim that it's sort of a non-interventionist policy, we know that if anybody gets into trouble, whether it's savings and loan companies in the 80s or government agencies guaranteeing mortgages in the mid-2000s, there's going to be someone there to try to put out the fire. And the United States has a pretty big history, actually, of intervening in the banking system, perhaps to its detriment. But just to show the big picture here, again, in the 70s, while the Vietnam War was pretty much drawing to a close, we went off the gold standard here. The final straw of the gold standard. Remember, it started going off it in 1933. Eventually, the U.S., you know, with the Saudis, went on to the petrodollar, but a lot of unemployment, a lot of inflation here. We got right around the end of the Vietnam War, we were 2x money supply to debt. Okay, I'm not saying 1x is what it has to be. No one knows. I don't know. But it's interesting that this is a pretty big mound of money relative to debt. Peaked again in the 80s, at the start of the 80s, which is exactly when the gold bubble was pricked, silver bubble as well, by higher interest rates. And then money relative to debt, is they were both, of course, growing, as you can see here, 1 and 2. They're still growing from, you know, $1 trillion debt, $2 trillion money supply. They're growing here to roughly 5 trillion each. In 1994, money relative to debt falls. Okay, so there's less money relative to debt, and then it reverses. And again, this is just a big picture one. It's not really a hot tip to understand what's happening in the markets. Plus, I can only update it, as I said, on Wednesday every quarter. So it's a pretty lagging indicator. But with the benefit of hindsight, this was a lot of money relative to debt. Okay. Now we have more debt relative to money, or at least historically. Usually, money is a little bit more. All right, in the modern, this is the modern banking era. We're about at 1x, interestingly. So this is a low. We actually have a little bit more debt than money. Oh no, actually, as of March, money is back up, but pretty much 1x. 1x. Here we had more debt than money. Like as interest rates were rising, rising, and the Federal Reserve was cutting the base money supply. So what I talked about Wednesday, and I said I would do a chart, show a chart. This is the benefit of talking through this stuff with you guys as well, because I think of some of this stuff on the fly. There's a portion of this M3 money supply which is really liquid and always trades in treasuries, okay? Actually, two parts. One is money market funds. The other is really more important is repurchase agreements, because repurchase agreements can go overnight. They can go monthly, but they can go a lot. And so they're huge. Both of those, money market funds and repurchase agreements, are part of M3, okay? Remember, M3 also includes M2, it includes M1, it includes M0. It's the broadest money supply. The difference between M3 and M2 is M3 is institutional, money-like instruments. M2 is retail, money-like instruments. So when people say M2 is like the best thing to quote, they're just wrong. But the Federal Reserve doesn't help us here because they don't publish the data. So anyway, let's look at these now pretty volatile components of M3 that trade in the market of treasuries. That is the debt. Here's the debt. There are a couple components of the M3 money supply which the vast majority of the assets are United States treasuries. All right, so what is that? We got to go back to this breakdown. Remember? Showed this on Wednesday. Let's take the Fed off here. I already talked about this on Wednesday. It's 4 components in addition. It's actually 5, but I don't have the 5th one because it's very hard to find. Nobody knows the answer. Good morning, Bitcoin Ollie. Thank you for reposting. So we have large time deposits. All right, number 1, the bottom there, 2 trillion. Institutional money market funds. Okay, that means it's only institutions. I am implying that there are retail money market funds, which is part of M2. Okay, institutional money market funds are 5.2 trillion. And then we have 2 components of the repo market: shadow bank repos, commercial bank repos. Shadow bank repos are like hedge funds, pension funds, money market funds themselves repoing. So you create another risk factor, another form of leverage. And if you added all these up, you get to something like 14, 15 trillion roughly at the moment, okay? This is non-M2, M3 money. So what I wanted to do, as I talked about Wednesday, is let's try to isolate the repos and the money market funds and see if we can see anything interesting there. All right, and so that is here. I'll take these off. Let's start with repos only, okay? Remember, what is a repurchase agreement? It's basically a liquid asset that trades like cash. Okay, so most of the time, the collateral in a repurchase agreement is the United States Treasury bill, note, or bond. The Treasury itself is not moving, but what parties create is a repo. repurchase agreement, where basically you're collateralizing the treasury to do other stuff. You could be longing, shorting, you could be using it for collateral for another loan to take, which is what a repo is as well. It's a form of a loan. But these are very liquid instruments. And so what they allow basically is for the idea is that someone who holds a treasury bond, you create instant liquidity to do stuff with it. And in effect, it means that the treasury bond is trading around like cash. That's why it's part of the money supply. Repos are part of the money supply because they trade around like cash, essentially. Okay. And remember, M3 is institutional money, right? M3 here, which is total $36 trillion, a lot of money. It's United States money. Remember, M3 is like 14 trillion. It's all institutional money that's in M3. Okay. So here are the repos. And looking at only, and I'm even simplifying it further. Remember, here I had commercial bank repos, then shadow bank repos, and then the Fed as well as a negative because it actually takes liquidity out from the system. Now I just have Fed and non-Fed. Okay, so I'm adding the shadow bank and the commercial bank repos. It's confusing. You got to go through all these numbers, but same thing. We had an explosion of usage of repurchase agreements before the GFC, and now we have an explosion again, which is quite interesting. Let's look at what the Federal Reserve does, though, too, because the Federal Reserve, I'm putting it as a negative because the Federal Reserve also repos. And remember, when you are a repo party, you are taking on a liability, okay? So you are promising to pay back this loan in a day, in a month, in a week. So the Federal Reserve can also partake in this market where it becomes the counterparty to actually other markets that are here in the green. Okay, and so the net effect of that is if you can imagine number 2 here, which is the non-Fed repos, okay, number 2, would be much higher during the pandemic had the Federal Reserve not stepped in to dampen some of that liquidity. And so what the Fed would say is that they're providing confidence in the market, stability in the market by entering the repo market and not having, excess inflation, excess money floating around. They're intervening in the market. Looks very similar to what was happening with bank reserves back in 2008. All right, and bank reserves are for banks. You can think of bank reserves versus repos. Basically, bank reserves are for banks. Repos are for non-banks, primarily shadow banks. Although the banking system does partake a little bit in repos as well. So, interesting, if you just look from here, from 2023, when they started to raise interest rates, the Federal Reserve tries to get out of this position that it's had. It's unwound it. And now we have a lot of repos back in the system. 6.8 trillion, which is above the 4.1 trillion that was in GFC period. Okay. But now just brass tacks, let's take off the Fed to not confuse ourselves. As I said before, and someone on the chat looked this up on ChatGPT, basically, or on some AI. If you look at the total repo market, 2/3 of repos use treasuries, United States treasuries as collateral. And I checked this as well and looked at some other things, but the rest of the collateral is actually agency debt, which is a separate pile of debt. It's even more confusing. It has the same pricing as bonds. It's always assumed to have the same pricing. So like a 10-year agency bond will have the same interest rate as a 10-year federal, a typical 10-year treasury. But it's just another confusing thing, the United States government. It's like a sacred cow are the agencies. There's a Social Security agency, Fannie Mae, Freddie Mac, Ginnie Mae, a lot of mortgage debt that is basically guaranteed by the government. But other agencies as well, what they call agency debt. And I don't have that total value, but it's even more than the 36 trillion that we think about for the federal debt. Nonetheless, at the end of the day, repos are dollar denominated treasury assets, whether they're agency securities or treasury securities. That's primarily what this market is playing in. And so I wanted to ask the question, if we take this divided by the federal debt, would that show us any sort of tricks? So here it's non-Fed repo as a percentage, and here's the percentage. And I was thinking about this, I should write a paper on some of this stuff or whatever, because again, you really have to tear into the numbers to create this repo market as it is here, because they did not, remember, they stopped publishing M3 in 2006. But once you put it back all together, you can really see how much leverage was in the system with this chart in 2008. So what this was saying is, of those $4 trillion of repurchase agreements, which are basically treasury securities that are wrapped up in cash, a cash-like instrument, of the 4 trillion, that made up 46% of the federal debt at the time. And just using our eyes, we can see that that was by far and away a record. All right, this happened here during the Wall Street crash, some savings and loan stuff in the late 80s. It was pretty high and then popped and went down a little bit, went up to 21%, went down during the start of the 90s. It's not necessarily predictive at the time. Of course, no one even knew the data at the time, but if people did have this data and were really looking at it, I'm not, I wouldn't have known to call the top. Maybe this could have gone up higher, or maybe you would look at it here, 35%. You have no idea it goes up to 46% is the top, but it really shows the excess leverage in the system. So just to be clear, again, what I'm showing is shadow bank, commercial bank, these portions of M3 right here, right, which is a smaller portion is commercial banks entering in the repo market. Much more, it's non-banking entities entering in the banking market. All right, so 6.1 trillion plus 0.7 trillion, $6.8 trillion of repos. That's what is here. See, $6.8 trillion of repos. And it is rising. It is indeed rising, but we do have some time. If you would only use this as a benchmark of where it could go. Again, we could have many other problems in the economy. This is just one metric. But I do think this is pretty interesting that this, even at these record values of repos in the market, 6.8 trillion, it's only 18% of the debt. There's a lot of debt outstanding. So it's not necessarily a good thing, bad thing. It's just it's an interesting ratio. A couple more things to say about repos. When you see this value, remember, stocks and flows. That's what we try to understand with this stuff. So these are stocks, okay? Both the percentage and the green shaded area. These are stocks of repurchase agreements, notional value that the Federal Reserve can at least track of. And remember, after Dodd-Frank, they had to do much more research. Okay, I talked about this in my last video to put these numbers together. And then once they did put them together, they didn't even match their repos that they said were in M3 before. The turnover of this, or the velocity of this money, is extremely fast. Okay, so you can read anything from $1 to $2 trillion a day. All right, so that's 365 to $700 trillion a year is just the repo market in volume, in turnover. And this is not that. This is just the stock, the value. What is dangerous for the Fed and for the market is they are stepping back from this market. Okay. So remember, as you see, they were really intervening here, taking $2.5 trillion away in liquidity from the market. They were providing a liquid asset to market players, but saying, hey, if you do it with us, obviously you're taking your liquidity out of the market. There's nothing else that can be done there. Once you're with the Fed, it's just a safe, it's like a safe place for now. But that doesn't last forever, right? You can't just print money forever. So now they're trying to unwind this, and it looks dangerous. It looks very dangerous. Let's look at money market funds separately. Okay, so here's money market funds. And a little bit different. So remember back at this chart, here we have, remember this is the M3 money breakdown chart. Okay, it's stacked. You have large time deposits, institutional money market funds, and then repurchase agreements. Break them down as you wish. Number 2 is what we're going to talk about now. 5.2 trillion in money market funds, but I'm also adding retail money market funds. Where do they come from? They come from M2. So money market funds are across 2 different pieces of money supply, 2 different components of the money supply. What's the total? 7.4 trillion. All right, so look at number 2 here, 5.2 trillion. Number 2 on the chart, 5.2 trillion plus about 1.2 trillion or 1.1 trillion in retail money market funds. This is now total money market fund liabilities in the United States. This is the most analogous money supply to a stablecoin, by the way. So when Besant talks about how there could be up to $4 trillion of stablecoin demand for U.S. Treasuries, or really said the other way around, U.S. Treasury demand from stablecoin issuers in the next 10 years, this is where it's going to come from. And this is also flying very high. Okay. The growth was a little bit different than repo agreements, right? It wasn't as pronounced to the GFC, but it definitely popped. Popped twice, actually. Popped in dot-com bubble and then popped here. Now it's way up. These are just as liquid as repos. Probably a bit safer, though, because theoretically here with a money market fund, it's a simple one-to-one, just like a stable coin, right? So Tether has a few different entities, right? But I guess the main one's going to be in El Salvador for now. Might go back into the United States at some point, but they issue the token on the blockchain. They issue tokens on many different blockchains. And then with the money that they receive from their initial issuance of the token, they buy interest-bearing assets like treasuries. And that helps them. It's basically a wonderful business model if you have the ability to break into it as they did. And they're probably one of the most profitable businesses in the world at the moment because they just collect not free, but they collect great interest from the government with very limited overhead to just issue these tokens. Now, you could argue that the excess issuance of stablecoins, the excess demand from the market, more than it otherwise would have been, encourages the federal government of the United States to borrow more than it should. You can argue that, but the U.S. government's going to borrow more than it should all the time anyway. So I'm not sure. The point is, I'm not sure money market funds are the canary in the coal mine. I think repos are more, not necessarily money market funds. But anyway, it's a very liquid way to hold treasuries, and it is primarily treasuries that are backing these. So if we look at money market funds as a percentage of the federal debt, we have these big spikes here. We get up to 38%, 2000, 36%, 2007, and now we're again, interestingly, it's only because the federal debt is a huge number now. We're only at 20%. So that is money market fund percentage of the federal debt. Again, I'm not a doom and gloomer, but at the end of the day, I have the same conclusion as the doom and gloomers. All this is going to be good for Bitcoin. Too much liquidity, too much debt, too much papering over the problems will be good for Bitcoin. But this can go on a lot longer, I think, than most of the pundits' newsletters think. It's only 20%, quote only. Doesn't mean the market's not going to discount treasuries tomorrow. I don't know. But interestingly, these percentages really do show you the scale of the craziness of the 90s and the 2000s. So let's put them back and not put Fed repos because that just kind of confuses it. Fed repos are outside of the market. It's just it's outside money, just like base money. But remember, repos are for non-banks. So these are these two very liquid components of the money supply, most of which are found in M3, except for retail money market funds. You have to go and find that data. So I pulled that out and put that here. And these are very liquid drivers of treasury demand. And I should have colored these lines differently. They're going to be the same color, but you can add these. They're stacked as well. So basically, if you look at the axis, we get close to 80%. This is percent of the total debt. Right here. Very interesting. We get 36% from money market funds, 45% from repos. That is how the federal debt was trading in 2008. Mostly was in these instruments. And now it's only 40%. So as a total of these two black lines, which are just a percentage of the debt of the green shaded areas, we are interestingly at in half. So again, does that mean that the United States' debt situation is solved and we can go on forever? Absolutely not. Could we go on a lot longer than people think? I think quite possibly we can. Also, if you looked at, say, just here, right, from available data to the GFC, it almost looks like, you could go on forever. But obviously, they didn't, and you can't. 80% was the limit. And then from here, we are now in a different system, right? So from this point, we have way more debt relative to money than we used to have. Because remember here, we had more money relative to debt all through this period, all the way until 1995 and a little bit here. That's the primary reason, is now we have more debt relative to money. And we also have a lot of reserves, roughly speaking, relative to debt than we had before. So I'll pull up another chart here just in a second just to show you. Talked about this many times. And it's also interesting because a lot of other governments aren't looking great either. Europe is actually looking decently well. Europe does not, relatively speaking, have a lot of debt outstanding relative to, say, the money supply. But here's just back to the old same chart I've talked about a long time. Here's the central bank holdings of treasuries. Okay. So if you put that in percentage terms, they got up to 28% ownership. And now it's down to 18%. So again, this is ammo for the bazooka if they want to do it. This is why Donald Trump is so angry that Powell just continues to keep interest rates elevated and lower purchases of treasuries, or let old treasury holdings expire. That's basically what's happening, letting them roll off the books. Or both, really. Not buying more and letting old purchases expire. So even though we have huge numbers of debt, obviously, just nominally, 36 trillion is a lot more than 10 trillion, like it was during the global financial crisis. The numbers are certainly elevated more than they used to be in this case, right? 18% ownership. The highest we had was here, 18% ownership for the end of the Vietnam War. It's at least from their perspective, not at all-time highs. And so this is why I have the same conclusion as a lot of the doom and gloomers. But it's not because I think the dollar is going to zero tomorrow, or people will run out of faith of dollars. They're not going to buy dollars. They're not going to want to hold dollars. There is still room. Remember, the dollar is the best looking horse in the glue factory. But yeah, I hadn't shown this before. Let's just look at repos again. Non-Fed repos. This is probably, if there was one chart that could show you leverage of treasuries, it would actually be this one right here. It's how many, the value of treasuries that are really levered up for a lot of fast money trading. And it's half of what it peaked at. Well, less than half. In fact, 40% of what it peaked at, right? 18% here, 19% versus 46% before the GFC. So Bitcoin is an answer to this, obviously. And it may be too much nuance, but just to repeat the point, like I do think Bitcoin is much more longer term response to these things. It's the hyper Bitcoin is, again, I wouldn't be disappointed if hyper Bitcoinization happens, but the dollar network is gigantic. This is the dollar network. 6.8 trillion of repos. And remember, this is stock, not flow. As far as volume of these repos, daily volume, they're trading at least $1 trillion a day. At least. Now, another one, Hi, Tim. Yeah, I mean, I think it could even blow out more, right? So what the Federal Reserve is afraid of is that it will blow out even more as interest rates go down, right? People want to, if interest rates go down, people that long and short and do crazy things in Wall Street are going to want to do more of that because they're going to have lower yield in the traditional assets, so they want to gamble more, and so you could even get an increase in demand for repurchase agreements. And the Federal Reserve tried to stop this in 2020, and they did. They did. They probably stopped it to the tune of $2 trillion. Like, I'm not saying it's one for one here, but basically, you can imagine this green shaded area would be that much higher right here. See, it looks like it's kind of nice and subdued. That's simply because there are so many repo agreements that were just with the Fed itself, which again is just wild. It's like the virgin prostitute or whatever. It's just the Fed should not be in that market, but the Fed is. So I'm not sure how long it will take, but I think that it could go, again, it could go on for a long time. Let's take the Fed repos off just to see this percentage. So when the Fed got more and more involved, they took it down to only 12% of the national debt was in market participant repurchase agreements. Right? The Fed is not a market participant, so to speak. It's a monopoly. But for the markets, it was way low here, and that was primarily because of the Fed intervening. Now they're saying they don't want to intervene. They want to restore normalcy to markets. Here they did not intervene. Right? So here, they just stopped publishing the money supply. that was their solution in February 2006 was let's just stop publishing M3 because first of all we're calculating it wrong. All right, there's repos way outside of the banking system. They weren't counting shadow bank repos, as you can see here by their data, which came later after Dodd-Frank. I think they will intervene, probably. So remember, when the Fed buys, when the Fed does something like this, right, massively intervene in, say, the repo market, that suppresses rates. Okay, so by definition, if and when interest rates are deemed too high by the next Federal Reserve chair, that will probably mean that the Federal Reserve is intervening more, either in the repo market or in the bank reserve market, which is what banks play in. And yeah, I mean, typically the idea is that is an inflationary action. They can get away from it a little bit by they pay interest rates on these repos, right? So the Federal Reserve is, and they've lost some money, right, in this period. That Ben Bernanke said they used to never lose a cent on their open market operations program. I need to show this actually. They've lost money on these transactions because basically they're at this period they were receiving money from the Treasury for the bonds that they owned and paying more to repo market holders. Obviously, you can't do that forever either. So a lot of tricks, a lot of things where they try to sort of work the overall picture, but the market usually corrects for these imbalances. You know, Bitcoin was already peaking here. And now we'll bring it to Bitcoin, right? So Bitcoin is unrelated still, I believe, to these markets, right? So Bitcoin was peaking here. First pump was here, March, April 2021. And the second was here. Okay, way more. That's true. Perhaps the second pump had something to do with this, maybe, because the first pump was really the where you saw all the metrics change with Bitcoin in the last cycle. But overall, Bitcoin, I think, is on a different trajectory, as I've talked about ad nauseum, the power curve. So, again, because I didn't start my stream correctly, I got to find the percentiles. So there's different steps in the process, but basically here, interest rates were falling, markets were panicking, Fed was buying both from banks and non-banks assets. This is them buying from non-banks, the repo facility, as it was called. Theoretically, they kept inflation lower because they paid them interest rates. The Fed never used to pay interest rates at all. The Fed, the discount rate was the only interest rate that they would, and that's not even something they would pay. That's something that borrowers would have to pay. But all the other things, Fed funds rate, all that stuff, those are what banks were supposed to pay each other to work with federal funds. But from 2008, Bernanke started to pay interest on reserves, or the bank reserves, and also the repo market. Of course, they were paying interest as well. So they would like to say that they kept inflation down during a low interest rate environment. But you can't do that forever. So they're unwinding it. And now we have a tricky situation because this for sure will be inflationary. And it was inflationary. You know, when more M3 money starts to go into the system, prices will rise, all else equal. So it was 3.7 trillion. Now it's 6.8 trillion. Add on the money market funds. All right. With these two, I'd say, pretty crucial liquid treasury components, you're at 14 trillion. And then percentage-wise of the debt, again, just to show it one more time. Here's literally 80%, 81%. So, Bitcoin, still to this day, though, is immune to a lot of those activities. Right? But we are in a very interesting stage where we're not really pumping. We're just hanging around. Hanging around. People keep telling me low volume, in Bitcoin relative to prior cycles. I think that's probably true, but to get the total picture, you should add up the TradFi volume and the ETF volume. TradFi meaning treasuries like MicroStrategy, and then the ETF volume. Unfortunately, I don't have that data handy. If anybody knows how to get it in a cheap way, that would be helpful. So it's the same conclusion I always bring you guys back to is this is the curve. We're probably going to overshoot it. I don't see why we wouldn't. If somehow Wall Street keeps us on this curve, that'll be fine too. If it's only 125K by the end of the year, that'll be fine too. Which is right there. December 31st, 2025, 125,626. Good morning, Daniel. We did a exhaustive discussion on the repo markets, money market funds, this specific portion of the M3 money supply, and M2 for retail money market funds. But another way of perhaps looking at this, perhaps, I'm not saying this is for sure always going to hold, but when the green is well bigger than the light green, the dark green, when the dark green is well bigger than the light green, and obviously this black line gets pretty high, then you could say the Federal Reserve is running too hot relative to the Treasury. And when it gets too low, you could say the Treasury is running too hot relative to the Federal Reserve. And that's where we are now. A lot of debt relative to money, at least in terms of historical averages. But like I said, there are no hot tips here. I mean, you could, look at here right during the pandemic, we have a big peak in the money supply relative to debt, but then debt takes over again and pushes us well lower in this ratio. We were like, 1.8, 1.08, now down to 1. All this is secondary as far as Bitcoin goes. Bitcoin just does not follow those types of movements. It's more specific to its own adoption, to its own usage as a network. One thing I wanted to show as well was Fedwire. Okay, so this is the dark green, the whale that I have here, is roughly the monetary base of the United States. It's not exactly, right? This is the asset side of the Fed's balance sheet. So this is the treasuries that they hold with the money that they print. It's roughly the base money supply, though, okay? And it's just nice to show it here because it overlays against the debt. When banks settle transactions with each other, they'll do it with this money supply. How they do that, how is the mechanism? It's called Fedwire in the United States. Okay. We'll put this chart back on. This is Fedwire. All right. It's a massive network. Shows you how powerful the dollar is. Let's just take all these off. I didn't update this for May, but $1 quadrillion a year. $1.1 quadrillion is velocity, turnover, volume of this. I'm going to take off the debt of this. 6.5 trillion. It's actually like 5.7 trillion is the monetary base, but you get my drift. Now, what is Bitcoin's trailing 12-month transfer value? 6 trillion. All right. So Bitcoin's velocity is 3, right? 3x the market cap. Fedwire's velocity is way bigger. Which again, none of that leads me to conclude that even as bad as things are, as wacky as they are, as all the tricks that they're doing, as much as they do, dollar demand is not going to zero tomorrow. So we can look at the Fedwire supremacy on Bitcoin right here, which is a great trajectory for Bitcoin, right? Bitcoin has been rolling. It used to be 2.5 billion times smaller than Fedwire right here in August 2010. Now it's only 169 times smaller. A great improvement, to be sure, but we got a long way to go. We got a long way to go. The reason I wanted to bring up Fedwire is just to show you again, to hopefully to connect the dots. Fedwire is analogous to trading this. And it's slightly confusing. I should just show the monetary base number, but again, this is the asset side of the Fed's balance sheet. Assets equal liabilities. So these are all the treasuries they own. If you looked at the liabilities, which is base money, plus that Fed repo account, which is here, okay, you get the Federal Reserve's total liabilities equal total assets. Nonetheless, the point is, base money is actually a little bit less. It's 5 and change. Let's just call it $5 trillion is the base money of the United States Federal Reserve. It is that 5 trillion that is flowing through this Fedwire, okay, of a quadrillion a year. So it's unbelievable turnover. It's a massive network, a massive demand for dollars. Bitcoin will get there. I have no doubt Bitcoin will get there, but we're just at a completely different scale at the moment than Fedwire. And then, if you want to talk about repos, okay, so repos are also cash-like instruments, but they are using a treasury security, right? That would go through a different network. It's called Fedwire Securities. I don't have stats for that at the moment, but so there's two different ways basically to send money around. This is primarily the non-bank way, right, or the M3 way, the broad money way, which totals $14 trillion. And then there is the Federal Reserve way, the central bank way, and that only totals $5 trillion. But then you would get Fedwire if you look at how much this money, how many times it turns over, and it is a lot. It is gigantic. Yeah, now about 0.5%. So again, maybe not any hot tips or tricks, but I do think, again, I hope this gives you comfort, because my conclusion does remain the same as the conclusions of the hyper Bitcoinization people, or the, the more bombastic Bitcoin speakers. It's like Max Kaiser, right? Max Kaiser says all these currencies are going to zero, Bitcoin's going to infinity. But Max Kaiser deleted 2,000 tweets that said Russia was not going to invade Ukraine. Sometimes these people can be right for the wrong reasons, or they don't look at the statistics, the actual facts on the ground. and can also be wrong for the wrong reasons. So you got to be careful. I do, of course, agree with all these people that Bitcoin is going to the moon, but I believe it's going to take much longer. Much longer. Here is another one. It was just cool. This is more technical work than I would do, or I'm used to doing. Let's say this is my friend Sminston. He is just a great analyst, utilizing the power curve. And he's commenting on this paper that Rudd and Porter did. It was a peer-reviewed paper. It was actually extremely bullish for Bitcoin. But if you actually put their predictions, which as he said, this paper predicted nothing. And I have shown out-of-sample predictions of Bitcoin's price using the power laws far back as early 2016, late 2015. If you put their paper if you modeled it onto the actual Bitcoin price, this is what you would get. So another good example of today's theme, I guess. People that are probably going to be right in the very, very long run, but right for the wrong reasons and not looking at the core data. The core data is clearly here, as Sminston has shown. And this orange line would basically be the same if you stopped calculating in 2016. So this just looks like looks like you're standing on Pluto to draw something like this. I'm not going to complain if it's right, but how many times have we heard this from people? The power curve predicts 1 million all the way out by early 2030s. They predict 1 million by 2027. So anyway, I think it's good. It's a good framework for today's theme. I can't be certain that these ratios would continue to make sense. Okay, I should color them differently, but it doesn't really matter. The non-Fed repos are the first line. Total money market funds are the second line. This is basically, you add these two together, it's massive market appetite for leveraging up securities. I can't be sure that there won't be another huge crisis at, say, I don't know, when this number is 50%. But I would be less confident based on all of the overwhelming, overburdensome regulation that they've put on the system in the last 15 years. I would be less confident that a crisis would break out, for example, even right now. This is a good chart. This is a good chart for Bitcoin's network effect. So think about this. If Bitcoin is 168 times smaller in transaction volume than what the Federal Reserve does, right? 6-7 trillion to 1.1 quadrillion. Why would we think that if the Federal Reserve, adds repos to the market, takes away repos to the market, why would we think that would really have much to do with Bitcoin at all? On the edges, sure, it always does, but This is a monstrously slow and old system that we're talking about here. Slow in some ways. Antiquated. And this is just a completely different thing. I think this march higher is pretty interesting too. It's like reminds me of actually when we look at Bitcoin charts after the halving, the latest halving is much more predictable. It's like they started messing around. They stopped messing around from all these ups and downs, and they're just like, all right, let's try to keep our volumes clean and clear and predictable. I've probably lectured enough today, so I don't know if anybody wants to look at another chart. This is a good one, though. A lot of these you won't find anywhere else, but this one in particular, these two assets, repos and money market funds, these are gigantic holders of treasuries. And take that off. If you're wondering, like, what is the net effect of when the Federal Reserve intervenes in the repo market? It's the same thing as the as the deposit market or the loan market when they add base money, bank reserves to the ledger. It just it dampens the effect. Right, so this number is pulled down precisely by this, which you can't see when I have it hidden, but that's precisely why this is so low as a percentage of debt. So they remove market appetite for risk. And then, of course, you can always go reducto ad absurdum, right? Like if you want to just remove market appetite for risk, why doesn't the Fed just do everything? Obviously, they can't do that for many, many reasons. Good morning, Fred. Thank you. Yeah, this is a new one. This one right here. I think it's a good chart. Shows they got a lot more room to run as far as a repurchase agreement demand for treasuries and money market fund demand for treasuries. If you added those two up pre-GFC, you'd get close to 80%, over 80% of the national debt. It's a percentage of the debt, percentage of the national debt. And now those two markets are, quote, only 40% of the national debt put together. Huge, absolutely huge. This is where the stablecoin market will go. Is this money? This money is huge. It's getting bigger. The Federal Reserve is not in the market anymore, so the more money sloshing around in the public markets, that is the non-Federal Reserve market for repos. Stable coins are basically will come in. They could absorb a huge amount of this. Besant said already, he's on record. I think he said 3.7 trillion over the next 10 years. It's easily absorbable to take in some of this money, to capture stablecoin market, to capture some of these money supplies. These are two key components of M3, the repo market and the money market fund market. And this, yeah, well, you get that. Certainly get that. I mean, all this is good for Bitcoin, in my view, as I was sort of droning on about before you joined. But at the end of the day, it's all going to be good for Bitcoin. It's just our interpretations are different than other people's. This is the value of Fedwire, which is mostly Fed funds or bank reserves. It doesn't include repo transactions. I guess that would be in Fedwire securities, but still it dwarfs the Bitcoin market. So the more they do, the more Bitcoin can grow. But as you know, I don't think any of that has anything to do with Bitcoin's growth. I think Bitcoin's growth is on a network power, much more important just the growth that it's exhibiting itself by its own nature than any external shock or factor. Someone was asking me on Twitter about, again, and it's fine. Like, I know for some of you, this probably sounds like I'm droning on about the same topics. Some of you, you're not quite sure. I get a lot of repeat questions anyway, but none of these money supplies match Bitcoin. This one does. This makes sense. Okay, so this is the value of all the bank reserves, which is basically this. This is the asset side of the balance sheet, but this is basically the Fed's balance sheet. How many times does that transact in a year? A quadrillion times. Quadrillion dollars worth of value. It's massive, massive market. So that's a big enough market on its own. And then you get these M2, M3, M1 markets. These are way bigger on top of that as well. These are markets that lever up treasuries, lever up treasury collateral into the money supply. But if you wanted to do the apples to apples, put it all together, I think it's this. Available gold and silver plus unbacked fiat money, which means the monetary base minus, take myself off here for a second, monetary base minus government-owned gold and Bitcoin. So you have only fiat in the green line, basically. Only fiat and gold, traditional money. It's 44 trillion. By 2030, that number is going to be 64 trillion. Bitcoin will catch it maybe by 2040. %, is May. It's right there. May 2043. That's 100% Bitcoin dominance. So we might, in fact, I'm sure that we will be around that enigmatic $100 trillion number. It's just not the way most people are thinking about it. Most people are thinking about M3 today being 100 trillion, which it is. It's well over 100 trillion. But that's not why Bitcoin will go that high. It's because of it will match base money being that high. Let me get the old, since we're on this topic, I'll pull up the full money supply. of the United States. I still need to get it for other countries. But here is the full money supply of the United States. A lot of people talk about M2. M2 is not the largest money supply. That's only retail, non-bank deposit instruments like time deposits, savings deposits, retail money market funds. And then you need to add in institutional instruments like institutional money market funds, repurchase agreements, and large time deposits. All that's in M3. So the Fed has not published any of this since 2006, but you can back into a lot of the data from what they publish separately. That's M3. But Bitcoin's not comparable to any of that. It's not comparable to that or even M1. It's comparable to this. And really, you take out the repos because repos are for non-banks. This is central bank money for the banking system. All pyramids. And it really doesn't even pyramid on top of M0. This is physical cash, is M0. That's the gray area. This is what the entire banking system pyramids off of. Is just this. $3.5 trillion of bank reserves. Used to be 100 billion before the GFC, and then Ben Bernanke had a field day, bailing people out. And Trump is very mad because basically on net, interest rates are higher because on net, bank reserves are lower. Okay, so you see that bank reserves were about 4.3 trillion in December 2021. That was indeed the top. And for the last 3 years, 2022 on, we're down to net 3.5 trillion in bank reserves. The reasons, in case people are wondering why the bank reserves are negative and the M0 is positive, because everything else on this chart pyramids from the bank reserves. All right, so I can do, for example, demand deposits, which are basically M1 minus M0. All right, I can do a ratio there. Let's look pre-GFC. The ratio is typically that very sacred 10 to 1. A lot of the Austrian economists think this is such a sacred thing. I do not. I think just not having a central bank regulate would be that would be the only sacred thing, but they're here. So whether it's 9 to 1, 10 to 1, 11 to 1, this is the amount of demand deposits in the United States versus bank reserves, which is central bank money in the banking system, only in banks themselves. It's this one right here, bank reserves plus vault cash, very small amount. Then you can see we're in a new normal from the GFC, just crazy time. No ratio is the same. It's harder to see now, but let's take off M0. It's very hard to predict what might happen because there is so much, in fact, safety in banks relative to deposits. I'm not saying that the system is safe or that they're doing a good job in doing this, but Ben Bernanke was paying interest on these bank reserves, so banks chose to not lend them out, which was the initial intention, so there wouldn't be inflation, price inflation, but they've kept it there. Then if you want to look at M3, leverage over the system, we can put in that Fed repurchase facility, which again, back in this chart is here, right? when the Fed takes a liability against a counterpart in the market, which is typically a non-bank with the repos. You know, they're pulling liquidity out of the system. And so if you put that back to this chart, where is it here? Let's take off this ratio. Let's take off here. Now we just take M3, total money supply of the United States, which is 36.23 trillion at the moment, divided by total Fed liabilities, which are the black and the gray shaded areas here, as well as M0. But again, M0 is not really M0 is just cash. It's physical cash in circulation. Sorry, it's annoying why my scale resets sometimes. There you go. You get this number. So it was not central bank money that was out of control pre-GFC. It was M3 money. It was money market funds, repurchase agreements. And this is just a completely unhelpful situation now where these ratios mean nothing really. Completely different than the past. And on we go with the money printing and the protection. But if you only look at the money market funds and you only look at repurchase agreements, I do think this is an interesting chart as far as what bad things could happen. So this goes back to the top of the show, basically. Again, this is inside what I just showed you here. This is broad total system, M3. And this is just honing in on those repurchase agreements that are in the marketplace. It says non-Fed repos in the tooltip. That just means hedge funds, pension funds, money market funds as well can repo on top of something that they might hold with a counterparty. So plenty of room for stable coins to get into. But again, perhaps plenty of room to print more money, even though this thing looks like, and it is at an all-time high at $6.8 trillion total market of repurchase. Sorry, did I say money market funds? Or this is repurchase agreements. So repurchase agreements are basically treasuries that are wrapped up in a little debt instrument meant to be paid back either tomorrow or next week or next month. Basically treasuries that trade like cash. And this black line is a percentage of the total national debt of this market. So clearly, in hindsight, we can see that the GFC was a pretty wild event. Add on money market funds, which are completely analogous to a stablecoin. I know I have both in black lines. I shouldn't have made these both black lines, but basically, the repos are the first black line, money market funds are the second. Add both of those markets together, you'd be at over 80% of the federal debt in 2008. Now you're only over 40%. So a lot of room to run, in my view. A lot of room to run. Trump would like to fire Powell and have lower interest rates. A lot of room to run. But even having said all that, Bitcoin is different. And this is the most important trend for Bitcoin. definitely check back with me once we start running up. So basically what I do is I count here the days. These pyramids are basically days which the Bitcoin price has trended above the 90th percentile. My percentiles, if you've been following Sminston himself or Plan C or these guys, my percentile is a little bit different. Mine is based on a multiple above the trend as it evolved at the time. So that's why it's not a smooth line. But that's just how I'm doing it. So anyway, I've talked about this before, but you see here it's 98, 99, 99 days where the price in March 2021 was above the 90th percentile, and then it dipped off. A few times it dipped or rose above again in fall 2021. But mostly 2 to 3 months is all we get. Okay, here's 84 days, dipped off, then went up again. 34 days. If you count those together, except for this, 1 or 2 days where it was off, you're still 3.5 months. Same thing here. 111 days. So it's going to be exciting. It's going to be tense for a lot of people, but I don't, at least for the data that I look at, there's nothing that shows that this would be any different this time. The Malox moments will start, and then you got 3 to 4 months max. And you might have a double top, which again, if you were me, I didn't think double tops happened. So I thought this was going to go back higher again. So we continue to get fooled. I'm sure it'll be difficult this time around as well. It's not easy to let go of Bitcoin for fiat. Yeah. But if you're curious about my grand thesis for anybody that's tuning in now, it's just it's probably this. There's plenty of value in the base money supply that Bitcoin can capture and will capture. So again, this 44 trillion that you see here is all central bank money in the world, all gold in the world, all silver in the world. Less any gold and Bitcoin. There's about, I think governments have 50 billion in Bitcoin reserves at the moment. It's 500,000 coins times 100,000 price. It's roughly 50 billion, 60 billion, whatever it is. So you would subtract that out of this ratio because governments, you wouldn't want to count that fiat that's backed by Bitcoin. And I'm also backing out gold reserves because I'm already counting it here in the gold and silver supply. So, and that has risen a lot as the gold price has risen. That's 3 to 4 trillion now. Between that, 3.5 trillion is what governments hold in their coffers in gold. So basically, you run this calculation: available gold, available silver, plus unbacked fiat money. That's what this is. And this, in my mind, is the main numerator that Bitcoin is attacking. The Bitcoin network, as far as market cap, is the denominator. Or whichever way you want to say it. This can be the numerator. The green can be the denominator. If you do a Bitcoin dominance, then it's that. So we are only roughly 5% at the moment. And I think 100% happens. You could just round this and obviously say like 2040. Does it mean that we're all going to be on dollar standard by 2040? Maybe not. Maybe somewhere here, as Bitcoin gets to 30, 40 trillion in market cap, we start to think about a SAT standard, Bitcoin standard. So plenty of money, plenty of dollars sloshing around to take up stable coins, to take up Bitcoins. Sorry for those that have been listening longer, but I feel like I need to repeat some things as more people join the stream. But I try to approach this more from just a data-driven standpoint and not, although I like a lot of the Austrian economists, I also dislike a lot of their analysis of history. So like I said, you can be a Max Kaiser type who says that Bitcoin is going to infinity and all the other currencies going to zero. Fine. But he also deleted 2,000 tweets when Russia invaded Ukraine because he didn't think it was going to happen. So people can be right in the long term, wrong in the short term. This network, which is the dollar network, the Fedwire network, the quadrillion dollars transacting in the course of a year, is not going to zero tomorrow. It's not going to zero next month. It's not going to zero a month from now. It's not going to zero 5 years from now. It's still going to be around. It's the best looking horse in the glue factory. It's great hawking, though, by Bitcoin. Now I'm just repeating things. So if people want to see different charts, let me know. But Bitcoin was 2 billion times smaller than Fedwire here in 2010. Now it's only 168 times smaller. Nothing about the economics or even the network properties of Bitcoin needs to change here, by the way. The only thing that needs to happen is Bitcoin's price needs to rise. I have another one. We can look at the number of transactions that Bitcoin does divided by the market cap. Is that here? No. Here. Okay, so here's the power trend on the price. Sorry, this is power trend on the transactions. Nothing on the price, right? It's 88% R squared. This is how many dollars of market cap per transaction that goes through. All right, so back in 2021, we got 3 million, 4 million a day in market cap, whereas in 2013 top, it was 170,000. So if you think that can't repeat, I would just say think again, because it obviously has repeated many times. This is the channel. And we're getting very close to where we saw in 2021. When I say 1 sigma, I'm meaning that it is actually percentiles what I'm doing, but it means 2/3 of the time, so around 67% is what I'm showing in between in the blue lines. And then 2 sigma is typically 95% of the time. And that's a bit much for this metric. It has never really hit it. Here it did a little bit in 2013. But again, to avoid the Malox moments, we're above trend. So now we're at 6 million, $7 million of market cap. Think about that. $7 million of market cap per transaction of the Bitcoin network. But back in 2013, it was only 150,000, 100,000. And by 2030, the trend predicts actually where we are now, 8 million. 1 sigma up is 23 million. 2 sigma up is 49 million, 50 million. Is dollars of market cap per transaction that gets through on the Bitcoin network. Like many things in Bitcoin, it is a power curve, which simply means that doubling time is proportional to the size of the network. And I don't have that figure at the moment, but if you're curious about price, basically if we go back to this, all right, this black line will double every 13% increase in the life of Bitcoin. That's what that means. It's not exponential. So for example, we are here in June 2025, right? June 25th in the model. We're at about 6,000 days of the life of Bitcoin. So if you add, the number is 12.7%, but if you add roughly 700 days, right? So 2 years out from here, the trend should double. Okay, so if we look at the black line, June 2025, let's go out to June 2027, slowly on this model. We're in 2026. Oops, sorry, I already passed it. There we go. No, sorry, we're going to go to 2027. June 2027, 2 years out, is going to be roughly 12.5% increase in the Bitcoin network, $200,000 trend. Okay, so the trend was 100,000. We get to 200,000 at the moment in 2 years. But that's not constant. The word is proportional. That's what the power curve means. It's proportional. It's how networks grow. They're proportional. So if you look at this on my website, you can look at the power curve, very basic. It's not as refined as my curve, but you see the log. Power curves are straight lines on log scale, whereas exponential curves are straight lines on log linear scale. And here's that 12.7% I was talking about. Okay, so the 12.7% is a fixed number. That's when we run the regression, this is the ultimate sort of number to find. It's about 12.7%. But that reflects a different number of days, obviously, of life increasing the Bitcoin network as it gets older. So we are in this epoch, roughly here, between this one and this one. Like I said, I'm starting this randomly. So like this epoch actually already started in March 2024. Actually, it's about to be over next year. So in this step up, it's 630 days, but you just find it as you are. We're at 6,000 days of Bitcoin right now, so it would work the same. 6,000 times 12% is whatever it is. 762 days. Roughly, we're at roughly 2 year doubling time at the moment, and you can see that here. So that's what Bitcoin does. And in my view, and many others, I think that enjoy the power curve, like Fred and Plan C and Sina and Smithson and Giovanni, this is way more powerful than anything here. Even anything here for the United States. Like there's a lot of interesting stuff that you can look at and liquidity coming in, but it's the trend itself that is your friend. That's what I gave my BTC Prague speech. The trend is your friend, but you must follow it until the end, because it will give you heart attacks otherwise. Peter Zion said that Bitcoin was $17,000 overvalued when it was about $16,000 when he was on Joe Rogan. This is someone who knows a lot about statistics and population population tables and all the rest, but there's no idea when it comes to the Bitcoin network how it grows. I'm not seeing any other comments. If you guys want to look at another chart, I feel like I've been lecturing a lot this Friday. I already showed this. But these guys, Rudd and Porter, Sminston did a good takedown of their paper. This is actually how their model would look if you modeled it over what Bitcoin has done in the past. Clearly, Bitcoin is, I mean, again, I'm not going to complain, but we're trying to develop a thesis here of what's happening. This is not how Bitcoin grows. Yeah. It's one of my favorites. I mean, there's so many great Bitcoin obituary quotes, as we all know, but this is one of my favorites. I thought it was in fall of 2022, but regardless, yes, it's somewhere here. Start of 2023, somewhere right here. Right there. Obviously, there's another thesis some people have that maybe it will just, the effects of these booms will be dampened lower because of TradFi coming in. I'm a little bit sympathetic to that argument. I think that it's possible. I don't know which channel he's drawing here on the. It's probably like the 95th percentiles. But I think the basic tenement of anything really is it as scale happens, it gets heavier. So even though the doubling time at the moment is 12.7% the life of the network, again, different than, it's not constant like exponential growth. It declines as time goes on. It's possible that Wall Street, due to all the instruments and stuff, will keep things around the trend. But I'm still tending to think that the pendulum swings pretty rapidly in markets. And in November, when grandma is trying to tell you to buy Bitcoin, and I feel like we could have another boom pretty similar to the last. But this is a great, just a simple, nice overlay of, again, you know, supply and demand framework, all these things. It's just not taking into account what a network does. Okay, so again, back to our Fedwire. This is the dollar network, basically. Of course, it's even bigger than this because, you know, Visa, MasterCard, all the rest, they do trillions and trillions of transaction volume. But this is gigantic. And this is just the base money. This is Federal Reserve, Fedwire. So I think it'll take a long time for Bitcoin to really I mean, relatively speaking. I don't expect hyper Bitcoinization tomorrow is my typical message. So, good morning, Demon Dogs, or good afternoon, wherever you are. Probably one more thing to talk about is the revenue. Where is it? This is what I want. So this is the best chart. This is probably the best table that both these tables are really good, but you can find it on my site. We'll show you the nature of how the power curve grows, how Bitcoin grows. The growth rate is slowing, but it's still huge. Right? We're in 40. By the end of the year, we'll be at 42% per year. Compounded, that's still 10 times higher than anything you can hope to get on Wall Street. Yeah, I gotta go back and check that. It always happens on the fly. All right, it's revenue. So I showed this as well at the start of the week. This is really incredible, actually. Extremely, if you think about the revenue of like the gold market, right? It's hundreds of billions per year in new gold ounces that are come and sold in. Oil market, trillions of dollars a year. Those are flows. This is now flows of Bitcoin revenue. We're even lower than last cycle. All right, last cycle topped at 16 billion. Okay, I don't know the exact number for all the miners in the world. This is just an academic calculation. You take all the fees, which are here, on a trailing 12-month number, which usually are not more than $1 billion max, right? You take the block reward. There's fees here, block reward here. Add those two together, you get something like 16 billion, 17 billion. Right here was the top. But then here with this halving, it's very interesting how let's take away the split. Like we've basically flatlined and then even went down the course of last year on a trailing 12-month basis. But now with the growth of the price, we're back up again. But it's very interesting how you can see you can see the halving effect on miner revenue. What else do I want to show? I think that might be it. As I said at the beginning of the stream, my goal is to get at least the dollar, the euro, the yen, the yuan, the pound, and the sterling, which are most liquid currencies, even though the yuan is really not liquid, but it's huge. And they're probably lying about the numbers, but whatever. But to get those in M3 form, in government debt form, and in monetary base form. So you can really see the difference in the ratios and how they grow. But as far as the United States, federal debt versus the main money supply. Typically a 1-to-1 ratio or a little bit more money to debt. Now we're right at a 1-to-1 ratio. It's also quite interesting. So here in the 70s, 80s, there was more money, more dollars of money per dollar of debt in the system, and then goes to 1 here. Clinton balanced the budget even here. But post GFC, this was a sign of a problem. More money to debt. And again, it's not right or wrong. Everybody knows we have a lot of debt. We talk about it. Extend the debt ceiling or let the debt ceiling expire. I'm not defending anybody here. I'm just saying, relative to how this stuff has looked over the last 50 years, 50, 60 years, it's actually less money in the system now, relatively speaking, relative to debt than at any time. And Bitcoin still does what it does. Maybe you can argue on the margin that all that liquidity that has been kind of pulled out of the system because of the high interest rates, because of the massive pendulum swing after all the stimulus in 2020 and 2021 worldwide, that maybe that's kind of keeping Bitcoin from ramping up higher now. But again, my thesis there is that this is the first driver in Bitcoin growth is the network itself. It's the price action itself. And all the rest, money supply, purchasing power, instruments, repurchase agreements, money market funds, stable coins, they are secondary. It's a secondary factor. Okay, guys, I think for Friday, it's good for me. I'm going to leave it here. If you have any other charts, ideas, concepts, topics that you think it would be interesting for me to cover, I will gladly do it. Just to say this, always say it, feel free to donate. My BTC Pay server at the bottom of the page. Sorry. You can find it on my website here. I try to be the anti-newsletter. It's all free, all online. But if you appreciate the signal, just hit me up here, please. Other than that, wish you all a happy Friday, good weekend, and I will see you on Monday. Take care.